What if I told you that while you're losing a chunk of your paycheck to taxes every month, some of the wealthiest people in America are legally paying next to nothing? It's not a hypothetical. A groundbreaking ProPublica report pulled back the curtain, showing how the 25 richest Americans sometimes paid little or no federal income taxes. For example, Jeff Bezos, the founder of Amazon, paid zero federal income tax in 2007 and 2011. This isn't a conspiracy. It's not even a secret. It's just a completely different financial rule book that they play by. In this video, we're exposing this hidden tax game and revealing the two sets of rules that exist in plain sight, one for people who earn a salary and a whole other for people who own assets. Here's the fundamental truth. Not all money is taxed equally. We essentially have two different tax systems. If you're a regular employee, you're almost certainly stuck in the first one. The first system is for people who earn a salary. That's most of us. We work a job, get a paycheck, and taxes are automatically taken out. This is called earned income, and it's taxed at the highest rates. You earn it, you get taxed on it. You have almost no flexibility. The second system is for people who own appreciating assets, things like stocks, real estate, and businesses. Their wealth doesn't come from a salary, it comes from the growth of their investments. This is capital gains, and it's taxed at much lower rates. But the real secret is their control over when or even if they ever pay that tax. That control is the key to their playbook. Now, let's be crystal clear. We are not talking about tax evasion. That's illegal, like hiding money or lying to the IRS. What we're discussing is tax avoidance, which is the 100% legal use of the tax code to lower your tax bill. The tax system is full of incentives put there by lawmakers to encourage investment. The wealthy have simply become masters at using these rules to their advantage. So how do they do it? Let's break down 5 of the key plays in the billionaire tax playbook. Play number 1 is called Buy, Borrow, Die. First, buy. Wealthy individuals buy assets they expect to grow in value: stocks, real estate, art. Second, borrow. Here's the magic. When they need cash, they don't sell those assets, which would trigger a tax bill. Instead, they take out low-interest loans using their growing assets as collateral. A loan isn't income, so the cash is completely tax-free. For example, Larry Ellison of Oracle has reportedly used his stock portfolio as collateral for billions in credit lines, allowing him to fund his life without selling shares and paying tax. Third, die. This is the final step. When the wealthy individual passes away, their heirs inherit the assets. A legal provision called the stepped-up basis adjusts the asset's original cost to its current market value. This means all the untaxed gains from the owner's lifetime are legally wiped clean for income tax purposes, allowing heirs to sell the assets with little to no tax. Play number 2 is all about creating paper losses with depreciation. This play is a favorite for real estate investors. It's called depreciation, and it lets you create paper losses even when a property is making you money. Here's how it works. The IRS lets property owners deduct a portion of a building's cost each year over its useful life. This is a non-cash deduction that shrinks your taxable income, sometimes to zero. So your rental property might give you $20,000 in cash profit, but a $15,000 depreciation deduction makes it look like you only earned $5,000 on paper. Pros take it even further with strategies like cost segregation studies and bonus depreciation, which at times has allowed investors to deduct up to 100% of the cost of certain items in the first year. This can create huge paper losses they can use to offset other income. That's how an investor can look poor on paper while still collecting serious cash in real life. Play number 3 is mastering the art of business expenses. This play is a classic for business owners. The tax code lets you deduct all ordinary and necessary business expenses. For owners, the line between a personal and a business expense can become wonderfully flexible. That business trip to a conference? Deductible. Dinner with a potential client? Deductible. A home office, car, or phone used for the business? All can be written off. While a salaried employee pays for their commute and lunch with after-tax dollars, a business owner can run these costs through their company with pre-tax dollars, significantly lowering their taxable income. Play 4 is the philanthropic tax cut. The wealthy are often philanthropic, and the tax code rewards them generously for it. One of the slickest tools is the Donor Advised Fund, or DAF. A DAF is like a personal charitable savings account. A wealthy person can donate a huge chunk of assets, often highly appreciated stock, into the fund. They get an immediate maximum tax deduction and completely avoid the capital gains tax they would have owed if they'd sold the stock first. The money can then sit in the DAF, potentially growing tax-free, and they can decide which charities to give it to over many years. It gives them the biggest tax benefit right away, with complete control over the money later. And finally, play number 5, the generational wealth wipe. We mentioned this in Buy, Borrow, Die, but this rule is the engine of tax-free generational wealth. The stepped-up basis is a provision in the tax code that erases a lifetime of investment gains when an asset is inherited. The heir receives the asset valued at its current market price, not the original purchase price. If they sell it immediately, their taxable gain is 0. Poof! Generations of wealth growth are never touched by income tax. Why should you care? Because it reveals that the tax code isn't just about paying your fair share. It's a set of incentives overwhelmingly designed to reward owning over earning. If you felt frustrated watching your paycheck shrink, you're not crazy. You're playing a different game. You're rewarded for your labor with a salary, which is the most highly and inflexibly taxed income. The wealthy are rewarded for their capital, which is taxed the least. Understanding this isn't about anger, it's about a mindset shift from being an earner to an owner. We've pulled back the curtain on the 2 tax systems, one for earners who pay full price, and one for owners who use legal strategies like buy, borrow, die, depreciation, and business write-offs to pay shockingly little. The goal isn't to break the law, but to understand how the system actually works. The tax code is a roadmap the wealthy use to their advantage. Knowledge is your first step. The more you understand the rules of money and investing, the more you can make those rules work for you. If you found this eye-opening, hit subscribe and turn on notifications. And if you're ready to start moving from earner to owner, check out our next video on making your first investment, because the journey from earner to owner starts with a single step. Thanks for watching.